What is up, YouTube? Welcome back to some more finance stuff. And in this video, we're going to be actually talking about some finance stuff. We're going to be talking about the technical parts of sales and trading, different products that you can learn today to gain a baseline understanding that'll help you massively when you're networking to impress people with whatever technical knowledge or the questions that you can form around the information you learned today. So make sure to stick around. And if you're wondering who I am, I'm just a kid from a non-target school who landed a sales and trading internship, prominent Wall Street bank, and all I want to do is help you do the same. Not an expert in anything, just speaking from personal experience. So let's get started. So what I'm going to be talking specifically in this video are the different products that people actually trade, why they trade them, how they trade them, and just the basics of all of those products so that you can understand them and develop better questions when you're networking. The products I'm going to be covering are stocks and bonds, which everyone is familiar with, options, futures, swaps, and FX. Let's start off with stocks. Everybody knows what a stock is. It's just ownership in a company. When you buy a share or a stock of a company, you just own a tiny percentage of that company. If it pays you dividends, that means whatever the company earns, it pays you some of that money. And the primary way that you're looking to make money by owning stock is by the value of that stock appreciate. Simple enough. Let's move on to bonds. Bonds are a part of this massive world called fixed income, where the primary purpose of any investor that invests in this is to get a fixed stream of income while they hold this security. So a bond is nothing but you giving out a loan to whichever party that is issuing the bond. So let's say you buy a corporate bond that Apple issues. Essentially what you're doing is loaning money to Apple, and in return they're going to pay you periodic interest payments, and then at the end of that loan or at the bond's maturity, Apple will give you back that last interest payment and the principal payment for which you bought the bond for. I believe bonds are considered a lot less risky than stocks, especially with high investment grade companies, because of the fact that not only are you getting a fixed stream of income while you're holding the bond, but also in case of bankruptcy, bondholders are repaid first and equity holders are repaid last after everything else has been taken care of. Some things that you should keep in mind, very high level concepts with bonds that you should know, the fact that bond prices move inversely with market yields. What do I mean by this? Let's say that you have a bond that pays you 6%. If market yields move up past 6% for that kind of a bond, then the value of your bond goes down because people can go invest into the market at a higher rate, whereas with your bond, they're only getting 6%. That's why the value of your bond goes down. The opposite is true. If market rates go down to, let's say, 4%, your bond is more valuable because it's paying 6 instead of the rest of the market, which is only paying 4. So this is a very important concept in bonds, one of the most basic concepts that you got to know if you're speaking with anybody in fixed income. Moving on, we have FX, as in foreign currency. This is the largest financial market in the world. People might think it's the stock market, it's the largest financial market, or the bond market. No. Foreign currency is the largest financial market in the world. It is traded heavily by both corporates, retail investors, and speculators. One key thing that you gotta understand in Forex is that everything in the market is quoted relative to another currency. So there's no such thing as buying the US dollar. The US dollar relative to the euro, or the Japanese yen relative to the dollar. Because dollar is the global currency, everything is typically quoted in relative terms to the dollar. And if anything is quoted in relative terms that doesn't involve the dollar, such as, let's say for example, the Japanese yen relative to the euro, then that is what is known as a cross rate. FX market is largely used by corporate clients who want to hedge their currency risk. For example, someone like Apple, they have sales in both places like Japan, India, China, as well as the United States. Now let's say the currency in China decreases relative to the US dollar. Now the value of those sales might differ, and they want to hedge away that risk, and they do that through the use of FX. Other major players in the role are hedge funds or speculators that may use macroeconomic trends to identify whether a country's currency might be decreasing in value and take speculative bets based on that. So now that we've got the basic stuff out of the way, now it's time to delve into the more fun stuff, and that is the big world of derivative. Now what do I mean when I say a derivative? Derivative is a security that derives its value from another security. So in the world of derivatives, the most popular ones we've got so far are options, futures, swaps. Now these are a lot more complicated than just your straight stocks or bonds or FX. They have a lot of moving parts, especially options with all their Greeks, that change their value based on a lot of factors and not just whether the price goes up or down. Again, I just want to mention that this is a very baseline understanding and a very basic overview of what all all of these products are. If you want more in-depth analysis, I suggest you do some of your own research on this. Don't really have the time to cover very in-depth concepts of options and futures and swaps in this video, but if you guys do want a detailed overview of all of these, I'm happy to make it. Just let me know in the comments. So let's get started with options. Now, when talking about options, the first basic thing that you got to know is that there's two types of options contracts. There's calls and there's puts. Before defining what a call or a put does, it's important that we define what an option contract actually is. An options contract, especially an American style options contract, gives you, the buyer, the right, but not the obligation, to buy the underlying security at a specific price known as the strike price. Now, if that definition sounds a little confusing, I'll give you an example of this right after I define what a call and a put is. Call option is simply the right, but not the obligation, to buy the underlying security at a certain price. And a put option is the exact opposite. It's the right but not the obligation of the buyer to sell the underlying security at a specified price. Now, to understand this much better, let's give you guys an example of what I mean by all this. Let's say, for example, that you have a bullish view on Apple stock. Currently, just for round numbers, it's trading at $100 a share, and you think it's gonna go up to $150 a share. Now, another important part of options to note is that one contract controls 100 shares of the underlying stock. Let's say in this Apple example, that you're bullish, and what you decide to do is buy a call option on Apple with a strike price, also known as an exercise price, of $100. Now, let's say that your theory proves to be right and Apple stock does go to $150. Then on the expiration date of the option, you would choose to exercise this option because you have the right to do so as the holder of that contract, which means that you would get, if you exercise that option, $150 minus the strike price of which you exercised that, the $100, times 100 shares, because remember, each contract controls 100 shares of the underlying stock. So your profit on this exercise would be the 50 times 100, which would be $5,000. Now, you might be saying this sounds absolutely amazing, but you got to keep in mind that this is given that the stock price increases to 150. Let's say it increases just to 110, then it would be $10 times the 100, or just $1,000. The other thing you've got to keep in mind is that that option contract that you bought has purchase price on it. There is a premium that you have to pay to buy that contract. Now, typically, beauty of options is the fact that you can spend a fraction of the money to control 100 shares as opposed to actually buying 100 shares of Apple. For example, when the Apple shares were $100, let's say that you wanted this same $5,000 profit, assuming the stock went up to 150. To buy 100 shares, you would have to do 100 times 100, which would make your cost be $10,000, whereas a single options contract might only cost you $1,000, for example. Now, in the real world, these numbers don't really make sense unless you're looking at options that are priced 6 months until expiration. Typically, weekly options or monthly options are only priced at hundreds of dollars for stock like Apple, but that's besides the point. This is just to highlight the concept of what options are actually for. So based on this example, if you were to buy a put option on Apple when it was at 100 and then Apple price went to 150, then all you would lose is the premium that you paid for that put contract. Because remember, you don't have an obligation to exercise that contract, because if you did, you'd be down $5,000, whereas you're only down $1,000, let's say, if you bought a put contract instead of the call contract. Now, on the other hand, let's say that you bought the put contract and Apple price went from $100 to $70. Now, if you exercise that $100 put contract, then your profit would be $3,000, because it would be 100 minus 70, which is the drop in the price, times the 100 shares, giving you a nice profit of $3,000. minus whatever you paid for the contract. I hope that made sense to you. I hope you understand options a little bit better now. If you're speaking to anyone who works in options, you can ask them questions that build upon this concept. You can ask them questions like, why do people trade options? How can you hedge with options? And different technical questions like this, now that you know the basics of options. The next thing we're going to be talking about is futures. A futures contract can be thought of kind of like an options contract, except in this case, you actually as the buyer or seller have an obligation to do something. Most futures that are traded on an exchange are cash settled, but if you do have futures that are physically settled on different commodities like wheat, then the buyer does have the obligation to take delivery of whatever commodity that they bought the futures contract on. Let me explain what a futures contract actually does. With an example, let's say that the current price of wheat is $100 for a bushel, and a futures contract for 6 months is priced at $105 a bushel. If you buy that futures contract, what you're essentially saying is, I don't care what the price of wheat is going to be in 6 months, but because I have a futures contract in 6 months that expires at $105 per bushel, I am obligated to buy wheat at how many ever futures contracts that you bought at $105 a bushel. Now, if the price of wheat has gone significantly higher than 105, then you've essentially made a lot of money because you bought wheat at 105, whereas it might be trading currently at around 110, 120, whatever the price may be. Let's say on the opposite case that the price of wheat actually went down and it's trading at 95 per bushel, then now you've essentially lost out on money because you're obligated to buy wheat at $105 a bushel. Futures contracts are used not only by speculators to bet on the price movement of different indexes or different commodities, but they're also used by manufacturers such as companies that require a lot of oil production, or farmers may use this wheat example to actually lock in the price of a commodity, fearing that there's a lot of price volatility in the future. Now, a great part of futures is the fact that you don't have to buy the whole futures contract using cash. All you need is the required margin amount in order to keep your long position on that future. And at the end of every day, if this future is on a listed exchange, all that happens is if your futures contract gains value, then money is deposited into that margin account. And if it loses value because the position went against you, then money is taken out. People love to trade futures because of this fact, is the fact that it's not capital intensive. It's not even as capital intensive as options, which are already cheap to begin with compared to actually buying stock. Futures are a great way to speculate on the price of commodities. Think about it. Who is actually going out there and buying 1,000 ounces of gold hoping that the price of gold is going to go up? A futures contract is a much better way to do that. So that's a basic understanding of futures. Again, there's a lot of in-depth technicals that affect the price of futures and different ways you can use it to hedge your portfolios. All you need to start networking with people that work in futures or any kind of commodity desk that also deals with futures is the basics in order to build smart questions around that. Now we're going to move on to swaps. Now, the most common type of swap there is out there is an interest rate swap. And it's kind of exactly what it sounds like. You're swapping an interest rate for a different interest rate. Let's say, for example, that you have a loan at a variable rate, let's say SOFR plus 200 basis points, and you sense that there's going to be a lot of volatility in the rates environment in the future, so you'd actually rather get exposure to a fixed rate as opposed to this variable rate. Now, let's say that someone else actually might benefit from this volatility in rates, but they are being exposed to a fixed rate right now instead of a variable rate. Now, a swap contract, essentially what it does is swaps your exposure to those rates, whereas you now have the exposure to the fixed rate and they have the exposure to the variable rate. Again, very basic, high-level overview of what a swaps contract actually is, but world of rates, especially in sales and trading, is a massive business out there. So if you're ever dealing with someone who's in this, understanding the basics of swaps and what they're actually used for, like in this instance, to swap out a variable rate for a floating rate, helps you really build smart questions to impress the people who are actually working in these fields. So I hope now that you have a little bit more technical understanding of all these different products and the basics of them, so that you can now create better questions on your networking calls, which will help you guys stand out, increases your chances of getting an interview. If you like this type of content and you want to get more advice on how to actually go about landing a front office role on Wall Street, I sincerely suggest you guys to subscribe and hit the bell notification so you don't miss another video. I've been through this process very recently, and I really hope that something of my experience can help you guys do the same. So I would really appreciate it if you guys would subscribe, help the channel out a lot. I'll catch you in the next video where I talk about some more finance stuff.